Hello and welcome to Unlock Your Life. I'm your host, Jennings Smith. Guys, today I have a really exciting guest. We've got Mark Miller. He's a financial powerhouse, got 40 years of experience. Guys, this dude is managing the Hilton family office. He's also started his own business and co-founded Hilton Tax and Wealth Advisors with Bradley Hilton, the grandson of Conrad Hilton. He's coming today. He wants to talk about wealth strategies, tax strategies, how the elite are doing it way differently than retail, share some of those secrets, and drop some knowledge bombs. So, Mark, welcome. Appreciate you being here.
Well, thank you, Jennings. It's an honor to be here with you today.
Yeah, so Mark, let's get right into it. Give me a little bit of background, like how did you get into this? How did you get in with the Hilton family, and what are you working on these days?
Well, I'll tell you, I've been in the business financial consulting business for, 40 years now. But I came out to college, became a broker, got to understand money pretty well, and was very very successful as a young person, as a broker and a financial advisor. Um, but I was kind of on the retail side of things, where I was enamored with buying stocks and bonds and things like that, and fortunately, I was able to really meet, as my career moved on, meet some very, very, very wealthy people. And they became my clients. And they started really teaching me that there was a different side to things. And I learned all about the institutional, what we call the smart money side. And that's how ultimately I started meeting a lot of people and getting involved with trust companies. And I met the Hilton family, had a long-standing relationship with them. They've made me money. I've made them money. And about 2 years ago, about 3 years ago, I should say, I was asked to become the manager of the Hilton family office. We can talk about what a family office is if you want to talk about it more in detail, if there's people that don't know what that is. But then we also started a company with Brad Hilton, like you mentioned, called Hilton Tax and Wealth Advisors. But I basically met the Hiltons just by rubbing elbows with people that, were worth hundreds of millions of dollars, if not billions of dollars, and just got smarter in the business and got better at investing, tax mitigation strategies, all sorts of things. And it's become just this incredible partnership we forged with them over the years.
Yeah, I think that it would be good to talk a little bit about that just because a lot of my listeners, they are doing apartment deals, commercial real estate deals. Obviously, they need capital. Some of my colleagues have
Mhm.
partnered with family offices. We're brokering a deal currently with a family office. And I think that it would be cool to get some insight on like what they're looking for and what type of deals that are attractive to them, like why they would work with private individuals, or if they're really more focused on, hey, if you're not institutional grade, don't really want to mess with you. How do people break into that world of getting a family office to sit down, have a conversation, talk with them?
Yeah, absolutely. And our family office is involved in a lot of different things. They can go to hiltonwealth.com, hiltonwealth.com. We have a page in there on the family office. And, we've provided capital to folks. We've done a lot of private equity deals. We've done residential developments. We've done commercial developments, things of that nature. We're always, looking for different types of investment opportunities and offerings to put on our platform, but also providing funding too, to really select projects too. I will tell you that we're very focused in the real estate side of most of what we're doing, just because the Hiltons have developed such great relationships over the years that we can often kind of demand kind of better deals from a lot of our real estate folks that we're working with, meaning, okay, if you're going to offer this and we're going to put this out there, what kind of assurances do our funders have, things of that nature. And that's kind of developed over the years. But that's, and we're there as a family office to try to protect the family members. I mean, that's a big part of it.
So are you alluding to you like to be more on the debt side than the equity side?
We're on both sides. We do like the debt side a little better, I'd probably say. I think we're more on that side than we are the equity side, only because the equity side comes a little bit, with more a risk associated with it. But it depends. It depends on the structure of the deals that we're working with folks on.
I saw an analogy earlier. It's like, you know, the debt side is the Ford pickup truck, right? It's safe, it's reliable, it's going to get you there. The
Mm.
equity side is the Lamborghini, and it's sexy, it's fast.
Right, right, right.
It could get you killed. So you've got to be careful with that.
We were just joking about that the other day about some of these NIL kids that are going through the portals. I'm afraid somebody's going to go out and get a Lamborghini and do that type of thing. So I say that because on the forefront of our mind, because we're kind of dealing that with one of our family office members right now.
Yeah, youth and money sometimes don't mix too well. So hey, let's talk
Hmm.
strategies. Like, what are you excited about? What do you see that the average retail, somebody maybe they've got 500,000 to a million to invest. What are you saying to that guy that's maybe different than a run of the mill financial advisor?
Yeah. So really our model is we're bringing the family office concepts that really folks don't have access to unless they have 20 or $30 million. I
Mm.
mean, really to be in our family office, you have to generally have a minimum of 20 million. But Brad Hilton and I's concept, we're just so passionate about this is because we're like on our soapbox about teaching people that it's so much better on the smart money side and the institutional side and that family office side in a sense. How do we bring those more down to Main Street? So we work with folks. We've got folks that have, portfolios of 250,000 and then obviously, up to multi millions. And really what all we're doing is we're just showing, generally people, you think if they're doing things right, and we do this in the family office, you're doing things right, things are not getting more complex. They're getting less complex as you get wealthier. But you have to have people that know how to structure that. But the wealthiest people realize the power of that and try to simplify things, focus more on safety and security than, say, a normal retail advisor would. Obviously, their fees are going to be less, focus less, you have less volatility. And ultimately, that all boils down to more returns and better returns over time. So it's a sharp contrast. And sometimes it's hard when we talk to folks that have been investing. I just brought a gentleman on board today that's been his whole life investing on the retail side, and he's made good money. But trying to explain, and in my book Hilton Wealth, Brad and I's book Hilton Wealth, we try to explain what the difference is between investing on the retail and between that and institutional. And it's tough. It's tough sometimes, especially if you've been investing a certain way your whole entire life. So, but again, like I said, we have a passion for that, and it's vastly different. It really just boils down to getting wealthier faster in much more efficient and elegant ways.
So how do you get wealthier faster?
So first and foremost thing that we talk about is when you look at the normal investor, more normal retail investor, and that can be all the way up to this, gentleman that I was talking to you has pretty darn good wealth, not quite enough to get in our family office, but he has pretty darn good wealth, and he's amassed it over time. He had some inheritance money and so forth. He was very, very focused on, hey, what are my returns going to be? I want returns, and what are the products? What are all that kind of stuff? And the retail environment, the folks on Wall Street want you to be like that. They want you to more focus. And in essence, really, when you talk about it, there's two things in investing, and that's fear and greed. They want people to focus on greed because it's a lot more positive and they can sell more. Okay. When in reality, the wealthiest of the wealthy investors, the smart money, generally, first and foremost, doesn't think about returns, they think about safety. So they're going to say, hey, how am I protected first? And then what are my returns? Which is totally different. Because of that, then they can build portfolio. It doesn't mean that they're not going to make good returns, because via the assets that they have, they're going to make good returns anyway. It just means that they can design kind of, you're looking at it like a pyramid, a really solid foundation where if something bad happens, they're not going to become, they're not going to go from having 50 million in wealth to 10 million in wealth, or 5 million, or lose it all somehow or something. So in that sense, you could say they have more to lose. But I kind of think in this model that Brad Hilton and I put together, I kind of feel like retail investors, in a sense, have more to lose, because they're paying higher fees, they're making less returns, they're having less volatility. So there's more of a possibility that they can lose all their money or lose huge chunks of their money than the wealthiest do. So that's the number one thing, is safety and security first.
It's what you're saying is totally resonating with me, because when I started, I had nothing to lose. It was like, okay, let's get out there, let's do deals, let's make returns for investors, let's take on risks, let's buy these half-empty multifamilies that are going to be, great returns, but they come with a lot of risk and downside, and as I've built my portfolio
Mhm.
out, I've kind of leaned more onto the debt side and buying more stabilized assets that maybe aren't as sexy as, oh, yeah, we can push the value of this building by 30, 40% in 2 years. Because I've seen what happens when those deals go sideways. And it's like I've got a lot more to lose now, and I'm more focused on capital preservation. And, if I can make 8, 10, 12, 15% consistently versus trying to chase 18 to 25% with large drawdowns and some of those deals becoming headaches, it's like I'd rather, not do that, not pursue that. But I didn't feel that way when I first started. But now that I have something amassed and built, I'm a lot more cautious about it, I guess I would say.
Yeah, and that's great, and that's actually, and there's nothing the matter with taking that risk, but how the wealthiest structure their portfolios is, and you'll see, and this is evidence, and you'll see very few people drop off the Forbes 100 list or something like that, because generally, as people amass money, kind of like what you're talking about, but that can even be at a much less level. It's all, life is all about levels, right? That they are starting to focus. They focus more and more on safety and security, but they're still taking that percentage of their portfolio and they're rolling the dice a little bit.
Mm-hmm.
Okay. And the neat thing, though, about being on the institutional smart money side is, though, if you're there long enough, you can start to find the investments, the deals, and all of that that may give you also some protection, even with really high end return possibility, with being able to make 20 or 25 or 30% per year. But that really truly is about access. And the Hilton's a great example of that. It's taken decades and decades and decades for people to come to them with offers like that. Okay. So ironically, what happens is things get safer and safer and safer.
Hmm.
And you'll find that with the wealthiest of the wealthy that stay on that Forbes 100 list, because they're never, even if they have a bad year, they're still going to be, if they're in the top 10, they're still in the top 10, you know?
Yeah. Yeah. And I can see that how time in the game is getting better access, right? When I first started, it was like I wanted to raise capital from anybody that would give me capital, right? At this point, I'm
Mm-hmm.
doing a couple deals a year. They fill up pretty quickly. I've got my established investor base that likes to do deals with me because I have a track record with them. And so those deals are kind of closed off to the public now, right? It's like if you didn't have a relationship with me in the past, you're not going to get access to my best deals because I'm either funding them with my own capital or I'm funding them with the 10 people that have been investing with me for the last 7 years, right? And so it's like the
Mm-hmm.
There's
Right.
money is everywhere, and it's getting the money into the right, safest, best risk adjusted return deal is a huge value add. So are you able to bring those
Yeah,
types of opportunities to these smaller people, let's say $1 to $20 million?
absolutely.
How are you able to
Oh
do
yeah, absolutely. And that's why I say, I mean, that's what Brad Hilton and I's model is. And in the several years we've been doing this, we found no one that has the same exact model that we do throughout the whole entire country. To where, especially bringing the tax piece and the tax mitigation piece, all of that, which by the way is the top 3 to 5 thing that makes the wealthier. Makes the wealthy wealthier. It's huge by saving, big chunks on your taxes that you can reinvest to help you build your wealth. But yeah, I think I think has been so important, and more people are learning more just because we're in the information revolution and we've got AI now going, all of the things. People are starting to learn this, but it's still, honestly, it's a little bit of it's still a who you know world. It always has been. And can you have access? Because it's one thing for these people to know these things, and there's been books written on you can do this, you can do that. It's another thing then to go to who you can trust to be able to implement these things. And we know, and that's primarily why I partner with the Hiltons, because I know that I can trust the Hiltons. People in general can trust the Hilton brand and name, and just know that, okay, it brings decades of trust and experience into any of those type of deals. And then we can push those deals, the ones that we can, not, don't get me wrong, not every deal that we do in the family office can we bring that down to Hilton Tax and Wealth Advisors. But a lot of them we can. And been a little of our challenge, but we've been able to really do a good job of being able to figure out how to structure some of those higher end deals where you can make great returns, even had some good downside protection, things like that. Bring that more down to the person that's got $500,000 or $1 million or whatever it is.
I got you. I got you. So, and are these mostly like 506C, 506B accredited investor offerings? Like, how are these offerings structured?
Many of them are, but some certain unaccredited investors we can get involved in our opportunities too with our, private equity firms, our issuers, some alternative investments we have, those type of things. But we also emphasize a little bit more traditional. When I say traditional, I'm not necessarily saying retail, but there's still products that are on kind of the institutional or smart money side. But like in my book, and again, folks, anybody's welcome to go to our website, which is hiltonwealth.com, and order my book, which is called Hilton Wealth, that we talk about and we take kind of a retail concept, which is putting money and investing in different buckets, types of risk level buckets. Now, that's not exactly how the wealthiest do it, but we needed some kind of structure to make it simple to understand, where we have a guaranteed safety bucket, we have an income generating bucket, we have an institutional managed money bucket, and then we have that private equity and alternative bucket. So we generally, through our Hilton True Wealth portfolios, we recommend balancing things. And, and I do know a lot of real estate people, and I'm not knocking it at all because I got my own real estate investments and everything. But some people are just real estate people. They're just, hey, I'm just going to invest in real estate. Well, that's fine. But let me just give you a quick thing. Most of my clients that have done well in real estate and they're older now and they've matured, they want diversity. I'm working with a guy out of Alaska that has done phenomenally well. He was in the storage space, plus did a whole bunch of commercial things, commercial development, and he's made multi-millions of dollars. Well, he specifically came to us because he's like, okay, I love real estate, but that's all I've done. I realize now that I'm older, I need to start diversifying. And I just recommend that with everybody from the get-go, that you need to have diversified portfolio and have access and have, percentages in a lot of different areas for a well-rounded, if I can say that, well-rounded portfolio, definitely.
Okay, let me dig into that because I am in that category, right? My brother-in-law is a financial advisor, and I've got a few things with him, like a children's college thing. I've got some money in the S&P 500, but very little, maybe like 50 grand.
Mm-hmm.
And the
Yeah.
rest is in real estate. It's like, okay, I've got multifamily, I've got self storage, I've got retail, I've got medical. I do my own hard money lending. I'm a co GP in a hard money lending fund, and my education company is based around real estate. And I understand
Hey,
that.
Jennings, you're kind of cutting a little bit out.
Oh,
Jennings, can you hear me?
yeah, I
You're
can.
cutting a little bit in and out. I'm just hoping the audience isn't hearing that. I can barely hear you.
How's that? Is that any better right now?
It might just be connection. I don't know, but go ahead. Sorry. Go ahead.
Yeah, and it records on my side, so it should be fine. But my point is, most of my
Yeah,
stuff
sure.
is real estate. I understand real estate deeply, and so I felt most comfortable investing in real estate. On top of that, when I've invested outside
Right.
of real estate, I've typically made bad decisions. And so, how do you like what would you say to a guy like me who I understand the industry, I know the industry, I've made money in the industry. Why do I want to diversify?
Well, I just think it's about, and there's always been a concept, and it's the same on of the wealthiest and the wealthy side. So let me just give you an example. So Warren Buffett, most people they hear about Berkshire Hathaway, right? So Berkshire Hathaway has made all this money over the years, and he invests in companies, and there's lots of risk, but he's great at investing in value companies, and over time he does great, and all this kind of stuff. They have no idea that anywhere from 50 to 60% of his personal portfolio is in very safe investments at all times. Okay, now right now he's going a lot into cash. Just because of certain things he's believing and all that, and whether you believe, I don't argue about all of that stuff. But even the wealthiest of the wealthy understands that there needs to be diversification. Okay. Even diversification, I've had very wealthy clients in real estate that generally are not, even though they're good at one part of real estate, they've figured out ways to diversify in other types of real estate, which I'm sure you understand. So it's the same concept though, but with your entire pool of assets, with your entire portfolio, that there's got to be some diversity for long-term stability. Maybe in the early years in real estate, if you're really hitting on some really great opportunities and all that, you pound away at those. But then at some point, just like the gentleman I was telling you about, said, I realize I need to be diversified in other things besides even the diversification I just have in real estate. So the thing I would say is, especially if you're just in one area of real estate, if something really goes wrong and really bad happens in the economy, I was just talking to another gentleman the other day we're looking at coming on board with us, and he was telling me about his stories in real estate where he's made multi-millions of dollars, then he lost it, then he made it again, he made it again, and it tended to be in the same area of real estate. So he's now a little more diversified in real estate, but again, he's also looking for diversification across many different types of asset classes and many types of investments.
Yeah, I mean, I can see your point. I mean, you look at like people that were heavy into core office right before COVID, like that's not the best real estate asset class to be in.
Yeah, yeah, absolutely. And you never know. I mean, that's the whole concept of diversification, and diversification and allocation are still, and they do preach that a lot on the retail side, but it's even more important and preached even more, especially diversification on the smart money side. So it's just a matter of it goes back to protection again. And it goes back to being smart long term and truly building a foundational type of portfolio that can weather pretty much any storm, no matter what happens. So you're not, high one year and down the next year, and dealing with that kind of uncertainty and risk.
Yeah. Because as you go through those valleys,
Pretty basic stuff, but it needs to be I mean, it needs to people need to hear. I preach this to my clients that have hundreds of millions of dollars. They've forgotten about it. They forgot that they need to be diversified. Why was I down 32% last year? Specific client that I'm thinking of. Somebody coming on board with us. Why was I down 32%? It's because you have all of your money in one asset class. So there needs to be some diversification there, and expansion, a little more expansion of paradigm shift of your mind to understand I need to go out and I need to learn about some of these other things and make sure that I diversify and allocate well in my portfolio.
so if somebody was to come to you that was like, "Hey, Mark, this sounds like I'm at the level that I need the like I assume it's just sort of like a fractional family office. Is that a good way to frame it?"
What we have is a multifamily office, and combined, it's actually the more modern version of a family office is a virtual family office. Virtual simply means that instead of us just having a set office and people coming to the office or even are employed by the office, a virtual office is much more efficient where we can go out all over the country and all over the world and find the best in class professionals in every area of finances. So we have the Hilton Financial Network has financial advisors and experts in every area that we pool in those individual areas from not just the country, but around the world. So we get the best of the best.
Gotcha. And so is this kind of like a holistic, like you guys do? I mean, CPA, you do the taxes, you do the investing. Am I off base there?
No, you got it totally right. I mean, the family office concept is a holistic concept to where we're able to do, and folks go to our website, Hilton Wealth. There's a page in there on the Hilton Family Office, and you can see how robust it is. I mean, literally, we have about, well, now I think we have 86 different distinct areas that we work in. So that's a little overkill to think about that, but you'll see when you look at it. So that is really what we're doing at Hilton Tax and Wealth Advisors too, is we're trying to bring that more holistic concept down. And then the biggest thing, why are family offices so big and why are they so good? If we got a couple minutes, I'll just give the quick background. The Rockefellers started the family office concept in the 1800s. What was happening was they were losing a lot of money every year because they had different advisors that were doing different things, and all these advisors would fight with each other, and they're all trying to carve out their piece with the Rockefellers.
Mhm.
They're working for themselves. They're afraid to talk to this person. The CPA is afraid to talk to the advisor. Advisor's afraid to talk to the insurance person. Blah, blah, blah. All of them are afraid to talk to each other. So there's zero communication, and they're competing. So they're not giving the Rockefellers great advice. So one of the Rockefellers was like, why don't we just, let's do it all. Let's hire the guys we like. Let's put them in an office and then they'll all work for us. Well, then you've got all these people that are working specifically for you, and they're all, instead of fighting with each other, they're all excited about coming up with new concepts, strategies, investments, all of that to benefit the family because they're all working towards one cause. So that's the family office, and it's a holistic concept. And again, that's what Brad and I are doing with Hilton Tax and Wealth Advisors is, again, bringing that kind of more synergistic type of communication and everything to the average investor, because the average investor needs it more than anybody. They even need it more than the wealthy, so the wealthy need it.
Yeah, yeah, I see that now. Something that my mind goes to is this all sounds great, but is it worth it? Like what does it cost? I mean, I'm not the Rockefellers, right? I can't afford to hire
Yeah.
10
Yeah.
lawyers and accountants and CPAs and finance and pay their salaries, you're talking millions of dollars a year to be able to
Yeah.
afford that.
Well, here's the crazy thing about it. Well, first of all, and I'll go to the family office. It's economies of scale. So if you have 100 families in a family office, everybody is pooling the cost. So it's very inexpensive to run the family office. Well, but then on the flip side, too, what's great about Hilton Tax and Wealth Advisors is since we're on the institutional and smart money side, generally the fees are tremendously less. Ironically, you're getting better service, better investment, and it's all coming with less fees. Now, why is that? Because people are like, well, that doesn't make any sense because they're used to the retail world. They're used to, well, you've got to pay your 1% or 1.5% or 2% or whatever it is, okay, generally. Well, the reason is because the on the smart money side, they can demand it.
Mm.
So there's a famous story about in kind of our world. I hate to use Warren Buffett here again, but there was it was like in the 90s, there was this hotshot company, a bioscience company, make a ton of money. And they were like, pitching Berkshire Hathaway. And they had these young guys running the thing and everything. And so they brought Warren Buffett in and his team. And they start one of their young guys that's really sharp and a great salesman, gets up and starts selling all the returns and what Berkshire Hathaway's going to make and all that kind of stuff. And Warren Buffett, being the gentleman he is, sat there and listened. And he said, "Thank you, sir, but how are you going to protect my money?"
Mm.
So the reason I tell you that story is you go back to, at the core, protection. And when you have a holistic type of environment and you have people that are all kind of working together and they're not fighting against each other, they can build that safety and security more into it. But still, obviously, and I'm not saying at the risk of returns. And that concept is again what we're doing Hilton Tax and Wealth Advisors for is and working. And don't get me wrong, I mean, we're still working out some of the how do we make that transition? How do we bring those things down to Main Street? Because they've been in that purview of people that have 20, 30, $40 million for so many years. But one of the cool things about it is just automatically that fee type of thing comes down drastically when you bring those concepts more to the average investor. Okay. And Buffett was, okay, how are you going to keep my money safe? But he was also, these guys were saying, you got to pay us this, this, and this. And he was like, no, I'm not going to pay you anything. And basically, they didn't understand the concept because they hadn't been in that space long enough that you've got to figure out how to weigh, you got to take the burden of the cost because me as Warren Buffett, I'm not going to pay you guys 3% for you to give me a return.
Right. Right.
And I don't have to because I'm about to give you, $4 billion.
Right.
So anyway.
Yeah. I mean, we've seen that even in raising for multifamily. It's like if you need to raise $4 million and one group's going to come in with 2 or 3, well, yeah, they're going to get the returns that are promised to the limited partners, but they're also probably going to get a piece of the GP equity as well. If you have to, the larger the investor, typically the better returns they can demand and terms they can demand, even though there's no more risk on the deal than the average LP.
Yeah. Yeah. And I mean, we're still working. I mean, and we're work in progress. I mean, we can see just when we started how much better we do from the get go than any retail advisor or the people that are hooked up with Fidelity and Vanguard and E-Trade and Schwab, all that kind of stuff. So from the get go, we are, but we're still kind of working on having a massively robust offering base. We have plenty for now, but we want to have more. And then, obviously we're never going to be like a Fidelity and all that because we're a boutique firm, but we don't want to be. But if we can have enough of those key things that we've been able to structure and truly bring down to Main Street, then we've got plenty to build really solid portfolios, great safety, keep the fees way down, and ultimately have less volatility and better returns over time. And that's a big thing.
Gotcha. Well, Mark, I really appreciate you coming on and sharing some of your knowledge. If there's someone listening that they think, hey, this resonates, I want to talk with Mark, what is the best way to get a hold of you?
Yeah, we make it real simple, kind of old school. Just go to our website, Hilton Wealth. Everything's there, and then just shoot us a note and say, "Hey, I'd like to get together." I'd be happy to personally talk to you too. Set lots of time aside to work on Hilton Tax and Wealth, I'd be happy to sit down with you for 20, 30 minutes, do a little strategy session, and see if it makes sense and see if we can possibly help them.
Awesome. Okay, so hiltonwealth.com. You can also grab the book written by Mark Brad, Hilton Wealth, through the website. But Mark, thank you so much for joining us. I really appreciate you taking your time, and it was a very enlightening conversation.
Well, great, Jennings. It's been a pleasure to be on with you today.
All right, guys, make it a great week and spend some time to unlock your life. We'll see you next time. Peace.